Ladies and gentlemen, good day and welcome to Nippon Life India Asset Management Limited Q2 FY24 earnings conference call hosted by ICICI Securities. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Anshuman Deep from ICICI Securities Limited. Thank you and over to you, sir.
Good evening, ladies and gentlemen. On behalf of ICICI Securities, it is our privilege to host the Q2 FY24 results conference call of Nippon Life India Asset Management. We will have an initial management commentary followed by Q&A. Without further ado, I now hand over the call to Mr. Sandeep Sikka, Executive Director and CEO. Over to you, sir.
Thanks, Ajay. Good evening and welcome to our Q2 FY24 earnings conference call. We have with us our Chief Financial Officer, Prateek Jain, Chief Business Officer, Saugata Chatterjee, Chief Distribution Officer, Arpan Saha, Head of Product and IR, Arun Sundaresan, and Matsui-san, nominee of Nippon Life Japan. Our detailed investor presentation and press release have been uploaded on the exchanges as well as on our website. I will break my comments in 3 parts. First, industry overview. Second, our performance. And third, the way forward. Starting off with the markets, equity markets in Q2 FY24 show divergent performance. While the Nifty 50 increased by only 2%, Nifty mid-cap and small-cap indices rose by 13% and 16% respectively. RBI held the repo rate steady at 6.5%, while the 10-year G-Sec yield increased by 10 basis points quarter-on-quarter to 7.22%. Coming to the data on mutual fund industry, the industry grew by 9% quarter-on-quarter in Q2 FY24 to INR 47 trillion. This is the highest quarterly growth since Q2 FY22. On a year-on-year basis, the quarterly average AUM grew by 20.3%. Now moving to flows, the equity category, excluding index and arbitrage, witnessed a gross inflow of INR 1.55 trillion and a net inflow of INR 492 billion. Both gross and net flows were higher on quarter-on-quarter basis. Strong inflows were witnessed in sectoral, thematic, small cap, flexi and mid cap categories. Investor interest in investing through systematic investment plans has further increased, with the SIP contribution to the quarter being INR 471 billion, 25% higher than Q2 FY23 and 9% higher than Q1 FY24. Monthly SIP flows in September 2023 stood at INR 160 billion, which was an all-time high. The SIP flows increased 7% quarter-on-quarter to 71.3 million. Arbitrage funds also witnessed strong inflows of INR 297 billion. The fixed income category, that is debt plus liquid, witnessed a net outflow of INR 594 billion after a large inflow we witnessed in Q1 FY24. ETF flow were moderated at INR 49 billion. At the end of the quarter, unique investors in the mutual fund industry increased to 40.4 million, while the industry folios increased to 157.1 million. Increasing financialization, higher awareness, better reach through new age tech platforms and distribution networks should see continued growth for the industry going forward. Now moving to our business performance. We closed the quarter with assets under management of INR 4.35 trillion. This includes mutual funds, managed accounts and offshore funds. Our mutual fund quarterly average AUM grew 12% quarter-on-quarter and 23% year-on-year to reach an INR of 3.51 trillion. I would now like to share a few highlights for the quarter. Starting with the market share, our market share increased 18 basis points quarter-on-quarter to 7.46, with the market share increase across all asset categories. During the quarter, we moved up one position to 5th in terms of total equity AUM. Our equity share also continues to grow. It has increased from a low of 6.18 to 6.53%, of which there was a 26 basis point improvement in Q2 FY24. It is important to note that this market share improvement has happened even after we stopped lump sum inflows into a small cap fund in July 2023 in investors' interest. Apart from equity, we also gained market share in other segments, including 33 basis point quarter-on-quarter improvement in liquid segment and 16 basis point quarter-on-quarter improvement in ETF segment. We continue with the balanced growth both in terms of asset class as well as investor categories. On the segmental front, our individual AUM, which consists of retail, HNI AUM, saw a market share improvement for the 7th straight quarter. Individual AUM grew 14% quarter-on-quarter to INR 2,094 billion. Market share increased 29 basis points quarter-on-quarter to 7.45. On B30 AUM, our B30 AUM grew 13.9% quarter-on-quarter to INR 719 billion, which keeps us amongst the fastest growing large AMCs in B30 locations. Our market share improved 25 basis points quarter-on-quarter to 8.58. This segment forms 20% of our AUM versus industry 18% for the industry. Performance of our large equity schemes remains strong, and this, along with our distribution network, digital capability, and strong risk management, helped us deliver a double-digit market share in net sales in equity plus hybrid segment in Q2 FY24. We added 1.2 million investor folios in the quarter and continue to have the largest base in the mutual fund industry with 14.6 million unique investors. We are humbled to have 1 out of 3 mutual fund investors in India. During the quarter, we also completed the NFO of Nippon India Innovation Fund. As at the end of the quarter, the AUM in this fund stood at INR 9.6 billion. I would now also like to touch upon the important aspects of our systematic book. The systematic flows are a stable and a key driver for industry's long-term equity flows. I'm happy to share that there have been a continued uptick in our systematic flows over the last 9 quarters, which has led to increase in our market share. Our monthly systematic book rose by 42% to 17.3 billion for September 2023 over June 2023. This resulted in an annualized systematic book of rupees 208 billion. Unique number of systematic transactions for the quarter increased by 20% quarter-on-quarter to more than 12.8 million. 64% of our SIP AUM has continued for over 5 years versus 26% for the industry. This bodes well for the volatile markets where folios with lower ticket size have demonstrated longer vintage and better stickiness. 16% of our SIP folios have continued for more than 5 years against an industry average of 12%. Moving on briefly to the ETF segment. At Nippon India Mutual Fund, we offer an industry-best suite of passive funds with an ETF ecosystem which is already in place and far ahead of the peers in terms of investor base and mindshare. We continue to be one of the largest ETF players with an AUM of 808 billion and a market share of 14%. The Gold ETF fund is the largest in the category, having assets of 78 billion. Our share in industry's ETF folios is 61%. We have 67% volume of 67% share of ETF volumes on NSE and BSE. Our ETF average daily volumes across key funds remains far higher than the rest of the industry. Last quarter, NAM India was appointed as one of the 4 AMCs for managing EPFO corpus for ETF investments. These investments commenced in the beginning of July 2023, and we are seeing we are seeing approximately 1/4 of the incremental EPO flows going forward. Moving on to a strong distribution franchise. Our digital strategy remains focused towards enabling better reach and leveraging technology advancements to provide frictionless experience. As digital and technological landscape is continuously evolving, the perpetual beta thought process has led to constantly strengthening our digital ecosystem and enabled simple and easy investment experience across the ecosystem for our investors and partners. Digital purchase transactions rose to 2.55 million in H1 FY24, up 64% year-on-year. We have witnessed close to 50% jump in Q2 FY24 compared over Q1 FY24. The digital channel contributed 56% of the total new purchase transactions for H1 FY24. Our physical distribution base is well diversified and with a wide presence in excess of 265 locations across the country. We have over 95,600 distributors in total and added roughly 2,600 new distributors during this quarter. Now, I would like to briefly update you on our subsidiaries, namely AIF and Singapore subsidiary. Starting with our Nippon India AIF, as mentioned in past, ATF continues to be an important focus area for NAM India. Last quarter, we appointed new head of AIF business, Mr. Ashish Chogani. This quarter, further to strengthen AIF business, we have internally moved a senior resource, Mr. Ashwin Duggal, as a deputy head of business. Under Nippon India AIF, we offer Category 2 and Category 3 alternate investment funds and have a commitment of INR 57.8 billion across schemes. We had launched our tech fund of fund in 2020, which was anchored by large Japanese institutional and corporate investors. The fund is in an advanced stage of deployment. Company has started getting into multiple business lines. Towards this end, we have recently launched our credit AIF and a long-only equity AIF, for which the fundraising is in progress. On the offshore fund, we will continue to focus on fundraising from international markets, looking at business opportunities with subsidiaries, associates, and large network of Nippon Life Japan. Nippon Life Japan remains committed in supporting NAM India's offshore business. We continue to see interest for India, not only from the conventional market, but are also getting initial positive inflows and interest from Latin market. In terms of regulatory environment, not much has changed since the prior quarter. SEBI had come up with a consultation paper in May 2023 regarding the review of TER charged by the AMCs. We continue to await details regarding the revised paper, post incorporating industry feedback. Now, on our financial performance. For Q2 FY24, revenue stood at INR 3.997 billion, up 20% year-on-year. Other income stood at INR 0.78 billion, down 5% year-on-year. Operating profit stood at INR 2.33 billion, up 25% year-on-year and 20% quarter-on-quarter. Profit after tax stood at INR 2.44 billion, an increase of 19% year-on-year and 4% quarter-on-quarter. As a part of our capital allocation strategy, we would like to reiterate that we have a stated dividend policy to distribute 60 to 90% of our profits to our shareholders. In FY23, we distributed 100% of our profits. Further, the Board of Directors have declared an interim dividend of 5.5 rupees per share, along with the Q2 FY24 results today. In addition, we also remain open to evaluate investments in strategic opportunities that can add profitability or complement our existing businesses. Briefly, moving on to ESG. As a signatory to UNPRI, we are integrating ESG aspects into various aspects of planning, operations, fund management, risk, and governance. Our ESG ratings are amongst the best in the financial services industry, with NAM India now rated low risk as per Sustainalytics. As a responsible investment manager, we are building a resilient portfolio that will provide sustainable returns to our investors and have a positive environmental and social impact. In conclusion, we remain excited about the business opportunities going forward. This includes both domestic markets, where mutual funds have become a preferred investment route, as well as global markets, where we would be aided by the network of Nippon Life, Japan. We continue to focus on sustainable, profitable growth for our shareholders in the backdrop of our distribution network, institutionalized processes, and strong risk management. With these comments, we are happy to take your questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. First question is from the line of Swarnabh Mukherjee from B&K Securities. Please go ahead.
Yeah, hi sir. Good afternoon and thank you for the opportunity and congratulations on a good set of numbers. So my first question is related to the yields. I just wanted to understand that, sir, when I look at the standalone business, I see that there has been a slight sequential dilution in yields, while at a consolidated level, there has been an expansion in the yields. So if you could highlight what would be the reasons, and is there, what impacted the mutual fund business because of which there has been slight reduction in yields, and whether outside the MF business we are seeing higher realization. That would be my first question. Secondly, in terms of gross inflow, if you could highlight how our market share is shaping up, because if we look at the SIP flow numbers and compare to the industry flows, I think we have seen a very strong expansion in that number. The market share is coming close to 10%. So how are we in terms of gross flows, given that we had stopped the lump sum investments in the small cap funds? So how is that shaping up overall? That is the second question. Thirdly, in terms of the EPFO inflows, so if you could highlight what is the quantum of inflows we are receiving every month or every quarter, and what is the economics of that scheme in terms of how are the realizations and how much of that is flowing into the bottom line, and how should we think about the yield trajectory from this perspective, given that this is a relatively lower margin product compared to our other products. So how should we think about the blended yields going forward?
I think you have 3 questions. I think I'll request Prateek to take the question on the yields and then Saugata Chatterjee on the gross flows. But I'd like to just touch on the last part on what you talked about, the EPFO. Broadly, the way you should see EPFO will be, I think will be investing roughly about 15,000 crores, roughly approximately per annum per AMC. This is going to be coming into existing funds, so there is not going to be whatever is the fees that we've been charging even before the EPFO mandate, that will continue. It is right now coming in the Nifty, and I think we are at this point of time charging 4 basis points. Okay. The way to your question, the blended yield will come down going forward. I would request you not to see as a blended yield, because this you will see separately. The EPFO money, that will be coming separately, and you should not mix it up with the overall yield of active, because that may not give you the right picture. So broadly, from our perspective, if you do the rough calculation, EPFO mandate will give us a top line of about approximately 15,000 crores per annum, and a bottom line of net about 5 to 6 crore rupees per annum. I think Prateek, if you take the question of yields.
Yeah. So, sir, in terms of the mutual fund yield, broadly it has remained the same as we mentioned in the last quarter, and also that the reason that despite the mix has slightly improved, but overall our size of the equity AUM has grown, and what we have seen is our growth in the quarter-on-quarter basis is almost 17% and half-yearly basis 25%. This is both because of the higher inflows, which I'll ask Chatty to share with you, both in SIP as well as on the lump sum basis. But also, in terms of the total new increase of the assets, what you see, this year itself, what we have seen is, our run rate net sales for this quarter was almost 3x of what we have done in the entire last financial year. Therefore, our assets have been growing much faster, and because of the SEBI-related formula, there has been some compression out there. And therefore, if you see, the yields have not moved up, but the thing is that, on an average basis, we are at the same realization what it was the last quarter. In terms of our other lines of businesses, as we mentioned that those businesses we operate more from a profitability perspective, and those rates are more in line or better than the competition. There are various asset classes where we are present, and the yields are very, very different. But more importantly, there the net yields are in the range of 66 basis to 100 basis point.
Yeah, understood. Very helpful. Sir, just one follow-up on this. If you could call out the category level yields which you share every time, and also for equity stock versus flow.
Yeah, so we don't give the yields on the net new flows, but on the segment-wise yield in terms of our book, we are almost about 70 odd basis point on the equity. Debt would be in the range of 25 to 30 basis point, liquid in the range of 20 to 15 basis point, and ETF in the range of 15 to 20 basis point. This includes gold, so yeah.
Yeah. So just to continue on the question on flows, for this quarter, what we find is our gross flows is in the range of 7.5%. And from a net perspective, we are roughly around 11%. If you take the quarterly last quarter flows, it keeps varying every month, but we are in the double-digit net sales every month. So what happens is, if our net sales is better than the market share, we tend to grow our market share, and that's the way the trend has been is being seen for the last now 3 quarters. Even on the SIP side, our market share definitely is higher when it comes to the number of SIPs and the contribution in the net incremental SIP book, which is happening in the industry. So both of them, both these components add up to the overall net sales growth in equity.
Right, so this flows that you shared, this is for the equity category, right?
Yes, overall equity category.
Very helpful. Thank you so much, and all the best, sir.
Okay.
Thank you. Next question is from the line of Madhukar Ladha from Nuvama Wealth Management. Please go ahead.
Hi, sir. Congratulations on a good set of numbers. Just wanted to get a sense on, on a quarter-to-quarter basis, has there been any significant movement in the yields across categories? So that is one thing I just want to get a sense on that. Yeah.
So as mentioned, that there has not been, a significant movement on the yield side of it. The overall yield have remained, about 41 basis points. And on the segmental one, as I mentioned to you, that because of the size impact and because of the new flow impact on the equity, there has been, some kind of a decline in terms of the overall equity realization. This is because this is governed more by the SEBI formula. Because if you see, the Q2 itself, our annualized net sales is 3x of what we did in FY23. So we are getting a very disproportionate high share of net sales. And also, the overall AUM has also grown about 17.5%. And so both of this has accounted, the higher AUM and getting into the newer slab. And hence, because of the new slab rates, our yields are lower. However, from our perspective, we have not made any changes to our distribution commission or, in terms of payout, etc.
Got it. This is very helpful. Just wanted to also understand what is driven other income this quarter?
Oh, okay. So see, this is purely mark to market of our total investable surplus. As you are aware that the company has a total net capital of about 3,500 crores, which has been deployed in our own mutual fund schemes. Broadly, almost about 85% of that has been invested in our own mutual fund scheme. There are another into FDs and tax saving bonds. And this is entirely the mark-to-market impact on these investments. 92% of this net worth is invested into financials or other financial investments, which is these our own schemes as well as FDs and bonds.
There is no unusual element in it, right? No one-off.
No one-off.
Okay. Perfect. Thank you. That answers my question. Thanks a lot. All the best.
Thank you.
Thank you.
Next question is from the line of Lalit Deo from Equirus Securities. Please go ahead.
Yeah. Good evening, sir. Congratulations on a good set of numbers. So I just had one question on the distribution side. So as you mentioned that we are seeing about 7.5% market share on the gross flows. So but across channels, could you give us more color where we are seeing the highest pickup in this flows and which are the segments where we want to see more pickup in this distribution channel?
Broadly, I think it's across the board that I think we are seeing the increase in market share. But I think where we'd like to see, I think from our point of view, always articulated our strength lies in retail. And it also makes economic sense because retail flows are more sticky. So we continue focusing on segments which can give us sticky assets. And typically what we have seen, smaller ticket size and SIPs have been more sticky. But broadly, I think a market share increase has been across all these segments. It's been equal.
Sure. And so just two data keeping questions. So as you mentioned that this quarter we have a net realization of 70 basis points on the equity. So what was it during the last quarter? Could you quantify it?
Yeah, so it was in the range of about 74 to 75 basis points. So because as I said, because of the size issue, we have and because of the inflows issues, we have seen some contraction in terms of the yields.
Sure. And so what would be the new SIP registrations during the quarter?
For us, roughly we are doing on an average 3.5 lakh SIPs every month. So roughly about 10 lakh net SIPs we are getting every month.
Every quarter.
Every quarter, sir. 10 quarter. Yeah. So 10 lakh is the quarterly net SIPs.
Sure, sir. Thank you so much, sir.
Thank you. Next question is from the line of Abhijit Sakhare. Please proceed.
Yeah, hi, good evening. The first question is it possible to give some color on the mix of the SIP book in terms of how spread out it is compared to your overall portfolio mix? Just asking this in the context of last few months or quarters seeing extraordinary activity on the small and mid cap fund categories as such.
So the good part is in our case, we have more or less equal distribution amongst the 5 market caps: large cap, multi cap, mid cap, small cap, and the flexi category. So we have quite a equal spread because what we have seen is our fund performance in the last 1 to 2 years has been across market caps, and hence the de-risking of our business is quite visible from the SIP flows which are coming into our fund.
Got it. And
any particular fund or category answer is, I think it's spread out.
Yeah. Got it. And just again, from the perspective of flows, I think the observation is that our representation or market share in some of the larger categories such as large cap, balance, advantage, we are sort of a little bit underrepresented. So just any thoughts on improving share of those schemes across different distribution counters as well?
I think it's as a money manager, I think our thought process to continue delivering best quality, producing best quality returns, and let the investors decide. I think from our perspective, I think large cap, multi cap, small cap, growth, I think all are doing very well. Balance and hybrids, I think is a growing category, and every asset management company has found a different niche that they want to grow. But to your question, I think we like to be represented equally. I think wherever we feel our market share is a little lower compared to is lower, I think we will continue building upon that.
Got it. Last one, just a question on OPEX. Like this quarter, we had the benefit of strong operating leverage despite double-digit expense growth. But looking ahead, do you see any possibilities of cutting back on expense line if the AUM growth turns out to be a little more volatile for the next 12 months? And subsequently, any guidance or indication on projected cost growth as well?
So Abhijit, if you look at it from a quarter-on-quarter perspective, it is quite flat. If you look at our employee expenses for the last 5 years, it has been pretty flattish. And it's just that, I mentioned that last quarter, we have upped our investments, for the future, as I mentioned last time around, that, to future-proof ourselves, we have upped our investment into 3 or 4 areas, specifically, marketing spend. You would have seen, we are more visible in terms of our marketing. We have increased our spend in terms of IT. We mentioned that, we are working on developing a data lake, around which, entire artificial intelligence will work on. The third part is that, look, we have been, to further improvise, we have been outsourcing some of our processes and, some of our other additional, because as you said that, look, we have been keeping a, quite tab on our employee cost. Therefore, there is some spillover of that is onto our other outsource or, other consultant cost. So these are the 3 areas, which has contributed largely this increase, which are predominantly, I would say that, that can be switched off on a tap. If things are not moving right, if the market corrects sharply, then these are the ones which are more discretionary and which can be switched off on tap. And then there have been a few one-off expenses. Last quarter we had some few one-off, and this also we have some one-off cases, which also are very discretionary. Those costs, can be again, we would, as and when we don't want to spend them, we can cut it off. So I would say that largely the increase what you're saying is on the discretionary spend. We are very conscious of increasing any kind of fixed expenses, including our employee cost, that as we have mentioned in the past.
Got it, sir. Thanks a lot.
Thank you.
Thank you. Next question is from the line of Shreya Shivani from CLSA. Please go ahead.
Thank you for the opportunity. Sir, I had a question on following up with the last question on the employee expense and the employee count. So probably if you can help us understand, there's been a reduction in the employee count, and is it correct that the outsourcing of the process that you're talking about has led to the reduction in employee count? Just a clarification on that.
No, so it has not, there has not been a significant reduction. If you see from the peak, we were almost about 1,200 odd people. It was in 2018-19. We are now about 985. 15-20 people here and there. So that is, in the from last year to now. So we have not have any significant increase or decrease in our total employees. When it comes to the outsourcing, I am saying that, look, more or less what we are saying is that any kind of non-core work, if instead of hiring people, if we can, put it out and give it to an outsource agency to carry out, that is how we have been working on. So it is not related to it has not related to any significant reduction in that cost.
So I think from our perspective, I think there's not been any conscious effort to reduce the headcount. Rather, we continue investing in our people. With a lot of digitalization that has taken place across and leveraging technology, definitely at the back end, there have been certain processes which have become more efficient with the higher use of technology. So definitely the reduction in numbers is more, which is one of the reasons which is also helping us to increase our operating leverage.
Sorry to interrupt, Ms. Shreya, your voice is breaking.
Can you hear me better now? Hello?
Yeah, it is better. Please go ahead.
So I'm just clarifying that the reduction in employee count is also the outsourcing of the processes and also the digitalization, which reduces the need for people, right? Need for manpower.
Perfect. You got it right.
Yeah. Okay. Thank you.
Thank you. Next question is from the line of Mohit from BOB Capital. Please go ahead.
Yeah. Thanks for the opportunity and congratulations on a good set of numbers. So just to reiterate, I was just seeing your presentation and now you're present in 265 locations versus 275 last year in Q2 and 270. So this is also a result of digitalization or is it something else?
I think we continuously, by day, we keep changing. Could be this sort of process of moving to a bigger location where those things keep happening. So I think there's no change in strategy. I think we have articulated in past also. We strongly believe both digital and physical will remain our strength going forward. We do not want to have a strategy of only digital. We believe physical is going to support our digital business. So I think you'll continue seeing us. So 5 branches plus minus. It could be whatever reason, clubbing of branches. There could also be going to a bigger, having multiple branches in one city and clubbing them together. So there could be different reasons for that. But broadly, the strategy remains. I think physical part remains a very important of our long-term strategy.
Perfect. My next question is towards the unique investors. I think we have good 36% market share over there. So in your experience, just wanted to understand how how is the behavior of these customers? Are they very sticky? And what age group they are? If you could just throw some light on that, that would be very helpful.
I think as Prateek mentioned, we are investing a lot on data lake. I think trying to understand the behavior of the investor. I think one of the earlier questions which was there, the expense going up is exactly we are investing a lot on data science, understanding the behavior of people. Won't be able to touch too much because every investor is unique, but I think broadly, I think what we have seen is the young investors who are coming in, I think they are seeing basically the starting point for them is systematic investment plan. The other part is basically what we have seen is small the ticket size, more sticky it is. But at this point of time, we will not be able to share with you a lot of analytics that we are working on our data because today the fact remains it's having 20 million investors and for some of these investors we have a history of more than 10, 15, 20 years. So I think we are trying to see and this is going to be a very important part of our strategy going forward. How do we put this data to use?
All right. Thanks and wish you all the best.
Thank you. Next question is from the line of Jignesh Shail from InCred Capital. Please go ahead.
Yeah, hi, and congratulations on a very good set of numbers. I just had one more like a macro kind of a question. There had been, a change in tax norms for this insurance companies, and thereby, the non-par, which is a savings product, had now been tax equivalent to what mutual fund or typical FDs would be. Are you seeing flows shifting? Broad level, do you see that kind of flows which will be shifting or the investor minds are shifting or getting more linear towards mutual funds, long-term mutual fund investments and all? Just your thoughts if you have any. That's the only thing I wanted to know.
No, so Jignesh, see, if you go by the initial assessment, since this has come in, I think industry has not witnessed too much money coming into the debt segment. While ultra short-term and liquid has seen some money coming in, but on the longer tenure, the money has not come in. So yet they are understanding and grappling it because, the tax break has been taken away. On the other side, if you would have seen that there is a good amount of money, which has gone into the, senior citizen savings schemes. So obviously, I think, as Sandeep mentioned, that, this is also to be seen in a longer term context rather than just, in a short view. But what we understand is in the last 6 months, also what you'll see that money getting into the hybrid funds category. From a industry perspective, it would be, both from a realization, from a, investors' long-term benefit perspective. It is much better that, he comes into hybrid category and takes the advantage of indexation as well. Therefore, you will see some diversification happening. However, HNI, as well as the, what you will see, the senior citizens beyond the, their investment into FDs, they will keep coming into the longer term. Also, market has been a bit volatile. Therefore, industry is also not going and pushing that hard. So this is combination of all of these things.
Understood. Quite helpful, and all the best for future, sir. Thank you.
Thank you, Jignesh.
Thank you. Next question is from the line of Prayesh Jain from Motilal Oswal. Please go ahead.
Hello. Can you hear me?
Yeah, Prayesh.
Yeah, there's a couple of questions, sir. Firstly, on the on the outlook on yields, can you give some outlook on yields as to how the equity yields will move from here in the second half, especially if you have a steady kind of a market scenario? Secondly, on the NFO yields or commissions, how has been the market behaving, and what is the product lineup for the second half?
I think if I've understood Paresh, your question, because your voice was not very clear, outlook on yield, and the other one is our own pipeline for NFO.
Yeah.
Right. So NFO, typically, what are the yields?
Yeah. So see, as regards to the, I would say that the competitive pressure which was there once, on the yields have largely reduced, and we are seeing higher revenue, on the new NFOs. These are in excess of our current book as well. What we are earning on the new NFOs, as we are, also with regards to the trajectory going forward. It will be a bit difficult, because if we continue to get this kind of significant flows, then obviously, the yield compression can be as high as what we have seen in the last quarter. But I'm sure, this will not remain as high. And, I could say jokingly that, look, last 1 month has been something where, market has corrected. Once the AUM goes down, we start earning slightly higher. So I would say that, look, very difficult to predict per se. But if you go, in a longer term, as we said that, look, there would be some 2 to 3 basis point yield compression, which will happen on an average basis, on an every year basis. This will continue for the next 3 to 4 years before the yields get stabilized. In terms of product lineup, we have been consciously not been coming out with lot of new NFOs, as Sandeep in his conversation has mentioned last time also, that we will only bring in NFO when we believe that it is a very good opportunity for an investor, and also it is something which is unique. Hence, per se, we do not have too many product lineup, but would request Chatty if you want to add something.
No, that's it.
Yeah.
Thank you. Can I just slip in one more? So, just on the international flows into India, so basically Nippon Life support to the AMC, what kind of route would be preferred? Whether the gift city route would be preferred, or direct investment would be preferred? Or what is the outlook there? When can we expect a real scale-up coming there?
So I think broadly to answer that, very difficult to specify which route will be preferred. Just to clarify, we are not talking about Nippon Life investing in India. What we are highlighting is Nippon Life helping us to get flows from other investors across the globe, and also Nippon Life, other companies, associates. Example, like I think we have launched with the company in Europe, we have launched the India Bond Fund. We have a couple of funds in Japan. So some are advisory, some are coming to, all funds are, institutions are different, and then they are taking a different route to come to India. Again, I'd like to clarify so that it's not misunderstood. Nowhere in the discussion we mentioned Nippon Life will be investing. It is Nippon Life helping NAM India to get a global distribution strategy to get flows from different companies where they have invested or where they have a strong relationship.
Great. Thank you. All the best.
Thank you.
Thank you. Next question is from the line of Gaurav Jain from ICICI Prudential Mutual Fund. Please go ahead.
Hi, sir. Thank you for giving me this opportunity. Just a follow-up on the previous question around systematic flows. When we say it is equally spread, do we mean it is equally spread across the 5 schemes of large, mid, small, multi-cap, flexi-cap is one? And second, given it is a 38% quarter-on-quarter growth on systematic flows, is there an element of small cap lump sum having moved and this number expected to see a dip eventually if people decide to stop small cap, etc.? And also, if you can help us understand the SIP, STP split here. Thank you.
So I think while we cannot give individual this thing, the top 5 funds are getting 80% of the SIP. I think we will not try to get into the individual category which is coming or not. And as you have seen our business model, whether it is at the investor, whether it is a fund level, it is a de-risk business model where we do not want any city, any distributor, any particular fund to get disproportionate shares. So I think broadly we can say, I think as I mentioned, top 5 funds get 80% of our SIPs.
And Gaurav, so small cap is stopped in July, but despite that, this quarter overall systematic flows have been strong, which we would have noted. That's number one. Second, apart from small cap, the other strategies like mid cap, large cap, multi cap, some of the hybrids are also getting flows. Yes, historically small cap has been the larger contributor, but over a period it's spreading across other funds as well.
Got it.
Are you there?
Yeah, thank you.
Thank you.
Thank you. Next question is from the line of Saurabh Vatva from Quest Investment Advisors Private Limited. Please go ahead.
Hello.
Line is unmuted. Please go ahead.
Hello.
Yes, Saurabh, please go ahead.
Yeah. On industry-linked question, basically the last few quarters have seen the larger bank-led and bank. You're the only one who has been doing exceptionally well in terms of performance. And with the merger of one of your peers with a parent bank, which was not the case historically, how do you see the competitive intensity moving on?
So, Saurabh, I think broadly the way we see, I think we've never been sponsored by a bank, and I think we have always believed ultimately it's all about execution. It's a reality we are not sponsored by the bank, but that's also a positive for us. We have an open architecture with all the banks in the country. So all the banks sell us. I think we have a very granular IFA network. So I think the competitive environment ultimately, first I think I'd like to say, even right now Indian mutual fund industry is very highly underpenetrated. While we have roughly about 50 players, I think there could be scope for another 50 or 100. And ultimately it's not about whether you are sponsored or you're part of the bank, because there have also been some bank-led AMCs which could not scale up. The key lies in the execution, and our focus will continue to be on execution and execution for profitable growth.
Second question was on the passives. I think we've been the leader in that due to liquidity. But how are you seeing the other AMCs coming into that, and with like more differentiated with a more broader universe. How do you see that panning out in a?
So sort of our answer remains exactly similar to this also. Ultimately, is execution. I think as and when regulations allow, I think we will also continue expanding our product suite in ETF. The only difference I'd like to give you is I think just seeing the global trend. Unlike active, wherein I think you have always a lot of segmented players. Globally, if you have to see the passive business, typically the top 2-3 have a very high substantial market share, and then there is a very long tail. So we need to see how it works out, but ultimately, like any business, it is going to be the execution, and the key is to keep responding to the needs of the investors. And I think as and when you differentiated products are allowed by the regulator, we will also continuously focusing on it.
Good, sir. Thanks a lot, and all the best.
Thank you.
Thank you. Next question is from the line of Bharat Sheth from Quest Investment Advisors Private Limited. Please go ahead.
Hi, sir. Thanks for the opportunity. Sir, in earlier question when replying to pressure on the yield, declining yield, so you said that, is it fair understanding that increase in AUM because of new net inflow as well as increase due to the market-related activity also?
Yeah, both. You're right. Absolutely.
Okay. So in that slab, so at what slab we are, when we are saying that pressure will remain for 4-5 years, so which slab we are, if you can please suppose our inflow increase substantially, then we decrease in the yield will be much faster?
No, see, if you look at it, that every 1,000 crore of AUM increase, you lose 1 basis point. And till the time your particular scheme reaches 1 lakh crore, you will keep losing it out.
Okay.
So that is how it works. And now this works both. And first of all, it works on your book, total book. So your book is at X, and then it suddenly becomes X plus 1,000, you will lose out on 1. And that it will be impacted on the entire value, entire basket. So that is one. So secondly, if this keeps going up, the reason for going up could be either your net new sales or due to market appreciation.
Correct.
So both these combination will lead to higher increase AUM, and because of the increase AUM, you will have lower, chargeable TR, and because of the lower chargeable TR, you will be, earning less.
Okay. Fair. Thank you and all the best, sir.
Thank you.
Thank you. Next question is from the line of Arushi Shah from Sushil Finance. Please go ahead.
Hello, am I audible?
Yeah.
Yeah, hi. Thank you for the opportunity, sir. I wanted to broadly understand the hybrid.
Sorry to interrupt, Ms. Arushi. Your voice is very low. Please speak a little louder or come closer to the device.
Hello, better now?
Yes, it's better now.
Yeah, thank you. I'm sorry. So I just wanted some clarity when you said that the hybrid funds are now going to gain more traction. So the hybrid fund yields are more like the active fund yields or more on the ETF side, and going further, how could the yield for the hybrid funds shape up?
So see, when we say this, so one I'm saying in the context of Jignesh's question on a macro basis, because the tax break has been taken away on the debt side of it, and therefore, we will see more money coming on the, over the period on the hybrid side. As far as the hybrids are concerned, those we earn on a equity slabs. So those are considered anything which is having more than 65% equity are earning on an equity slab basis.
It seems that we have lost the line of the current questioner. So we will move to our last question of the day from the line of Anthony John, an individual investor. Please go ahead.
So I would like to know that towards the end of your statement, you have said some strategic sale could be there in the offering in the future. Could you just brief me on that?
I think I'll just
acquisition, not sale.
So I think if what I mentioned was that we continue to remain open for strategic opportunities wherever it adds value to our existing businesses and is accretive for our for profitability point of view. So I think it is again clarifying, nothing to do with sale. It is about acquisition.
So which means you would be looking into acquisition of some AMCs.
I will not like to qualify that. I think we remain open for any acquisition which adds value, whether it's on the business, AMC, mutual fund, or any other part of the business that the regulation allows, which can increase the ROE for the business.
Okay. So is there any timeline for it, sir?
No, I think we will not. I think we continuously keep evaluating as a company. We keep evaluating various opportunities. I think as and when we have something, I think we'll be coming to and informing through the stock exchange.
Thank you, sir.
Thank you very much. Ladies and gentlemen, this was the last question for the day. I would now like to hand the conference over to the management for the closing comments.
So thank you all for joining this call. We call it an end to this conference. Thank you so much.
Thank you very much. On behalf of ICICI Securities, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines.
Thank you.